So don't we all want an edge over the market, but is that even possible? Well, in this video, I'm going to be looking at factor investing and how factor investing can impact your returns and whether there is a smarter way to invest rather than just buying the broad market. So in this video, I'm digging into the world of factor investing. It's an investment strategy that's proving very popular at the moment. It promises potentially better returns and smarter risk management. So I wanted to take a look at the results myself and see if they were all they were cracked up to be. So what exactly is factor investing? Well, in simple terms, instead of just investing in a broad market like the S&P 500 or the FTSE All World Index, factor investing focuses on specific company characteristics or factors that historically have shown to drive stock market returns. Think of it like focusing on specific ingredients that might make your investment portfolio recipe tastier. So why do investors consider factor investing? Well, it's for two main reasons, really. One is seeking performance or outperformance, and the other is managing risk. So academic research, like the paper from MSCI called The Foundations of Factor Investing, suggests that factors can help explain why some stocks do better than others. The idea being that tilting your portfolio towards these factors, you might be able to capture higher returns or reduce certain types of risk. Another paper called Factor Investing, the Best Is Yet to Come, explains factor premiums as a potential reward for taking on specific systematic risks. So what are these factors? Well, there's quite a few of them. There's several, but some of the most common ones include momentum. That's about catching the wave. It's a factor that identifies stocks that are performing well recently with the idea that that upward trend may continue. And then there's value as a factor. That's about finding hidden gems in the market, looking for stocks that are undervalued compared to their fundamentals like earnings or assets, and hoping that the market recognizes their true worth. Basically, it's bargain hunting. Then there's size as a factor. Think small. This factor focuses on small companies, the small cap stocks which might have higher growth potential than their larger counterparts. And then there's low volatility as a factor. If you're looking for a smoother ride, this factor focuses on stocks that tend to fluctuate less, offering a potential for more stable returns with a lower risk profile. But it also can include trading the volatility itself. And then there's quality as a factor, investing in companies with strong financial health like low debt, stable earnings, and strong balance sheets. These companies are expected to be like those sturdy trees that you can weather the market storms. In addition to those, I've also looked at leverage, which is about using borrowed capital to amplify returns, but also amplifying losses. And then I've looked at equal weighting indexes, weighting all the stocks in an index equally rather than market capitalization. So why don't we get to the important question? Do these factors actually work? Why don't we take a look at the performance of some of the more popular ETFs that track these factors and compare them to the S&P 500 returns and the FTSE All World Index returns over the last 1 and 5 years. Now, I realize that's a very short period of time compared to how long our investment horizon should be when investing in stocks, but it's still useful, I think. So I'll include this table so you can download it also, so you can look at it in more details, and include all the links in the description below. Now, the table is color-coded with darker green and green showing overperformance, amber showing similar performance, and red and dark red showing underperformance. And if we look at the last year up to early 2025, we see some interesting results. Momentum ETFs like the iShares MSCI USA Momentum Factor ETF, MTUM, and the Invesco S&P 500 Momentum ETF, SPMO, outperformed the S&P 500 and therefore the FTSE All World Index also. And not particularly surprisingly, leveraged ETFs like the ProShares Ultra S&P 500, SSO, outperformed the market because that was leveraged against the S&P 500, and we know how well that's done recently. Quality ETFs such as the iShares MSCI USA Quality Factor ETF, QUAL, and Invesco S&P 500 Quality ETF, SPHQ, also did well. They outperformed or roughly matched the S&P 500. However, value ETFs like the Vanguard Value ETF, VTV, and the S&P 500 Value ETF, and small cap ETFs such as Dimension US Small Cap ETF and the S&P 600 Small Cap ETF underperformed the S&P 500 over the last year. Volatility ETFs like the CBOE Global Markets VIX ETF and ProShares Short VIX Short-Term Futures ETF and the China Leveraged ETFs generally underperformed. Now looking at the last 5 years annualized, the picture changes slightly. Momentum, SPMO, Quality, Qual and SPHQ, and Value, AVUV, and Leveraged, SSO, ETFs have all generally outperformed the S&P 500 on an annualized basis. And many factors, including momentum, value, size, quality, and equal weighting, ETFs have outperformed the FTSE All World Index. However, volatility ETFs and some small cap have underperformed both benchmarks over 5 years. So if you're interested, take a look yourself. You can download this table through the link in the video description below, and also the link to all the ETFs that I've shown in that table. So what can we conclude from this? Well, firstly, I'd say this analysis does need to be expanded out further. Timeframes are crucial with these investments. As we've seen, performance varies significantly, depends on the time period and timeframes that we look over. Momentum might be hot right now, but value or size could take the lead in the future. Factor investing and performance seems to be quite cyclical. Also, markets fluctuate. Past outperformance is not a guarantee of future performance. What works in one market environment might struggle in another. Remember that China leveraged ETF we saw. Market conditions matter a lot. Then there's ease of management. Factor ETFs are, of course, easy to buy and sell just like any other ETFs. However, choosing the right factors and timing when to invest in them is far more complex than simply investing in a broad market index fund. Do you have the time and the expertise to constantly monitor the performance of your portfolio and adjust it on an ongoing basis? And then there's management fees. Factor ETFs often have slightly higher expense ratios than basic S&P 500 index funds or global index funds. While the difference might be small or seem small, these fees can really add up over the long term, eating into your returns. So while factor investing can offer potential outperformance, it comes with added complexities and isn't guaranteed to beat the market over time. For many investors, especially those just starting out or preferring a more hands-off approach, a simple, low-cost, cap-weighted index fund like the S&P 500 ETF or the FTSE All World might be the most sensible and reliable choice. They provide broad diversification, low fees, and historically solid returns without the need to constantly second-guess which factors are in favor. So let's get down to brass tacks. Is factor investing worth it? Well, as with all things related to investment, that's a very personal question, and you need to consider your own personal investment strategy. But it can be for certain investors with specific goals and a deeper understanding of the market dynamics. But for many, the simplicity and reliability of a broad index fund are hard to beat. And for me, I'm going to stick with a market cap weighted global index for all the reasons I've mentioned above. So what are your thoughts on factor investing? Well, it'd be great to read them in the comments below. And if you found this video helpful, please like and subscribe and share it with anyone else you think might find it interesting. Thanks for watching.